It's good to have you back on Global Business Report. Nigeria's biggest bank, Access Bank, has posted half-year pre-tax profit of just over 75 billion naira. That's a massive 62% jump on the year before.
Indeed, Access Bank's gross earnings are up 28% on the same period in 2018, and those were boosted by a 46% jump in interest income, a growth in its core business and in its non-interest income. It's the first round of financial data after Access merged with rival Diamond Bank in April.
And joining us in the studio is Access Bank's Executive Director of Risk and Management, Dr. Greg Jobome, and the CEO of Afrinvest, Mr. Ike Chioke. It's good to have you, gentlemen, with us in the studio. All right, I'm going to start with you, Mr. Chioke. Talking about Access Bank's half-year results for 2019, the first after its merger with Diamond Bank, what's your take on the bank's performance during the first half of the year relative to its peers? And do you think it has met market expectations?
I think we were actually quite pleasantly surprised, and indeed, the dividends of the merger is coming through. If you see the other top-tier banks that had announced their earnings, top-line growth was quite modest in the single-digit region, but Access recorded 26% growth to 320 billion naira for the half-year 2019. That's a massive jump. But even below that, you see that profit before tax gone up to 74%, which is 46% jump from the previous number. It could even have been higher, although you saw a growth in interest income. Fees and commission income did not do as well. Obviously, there are some derivative transactions that was down from what they had done in the past, as well as the fair value of equity assets in their portfolio. We've seen a massive jump in deposits. They are now from 4.1 trillion naira of deposits from 1.5 trillion about the same time last year. So quite significant. So you can see that that is helpful. Indeed, the context, the diversity of their deposit base is becoming much stronger. Once the funding capacity of the bank was driven by borrowings, including maybe a Eurobond placement in the past, or the commercial paper market. But now you have a much deeper pool of deposits, so that the borrowing mix has now gone up from 58% deposit ratio to something like 71% deposit ratio. So very impressive numbers. Investors should be delighted. I think they've also announced an interim dividend of 25 kobo, which is reassuring.
Oh, reassuring indeed.
Well, staying with you, Mr. Chioke, if we were to focus on the area of profitability and efficiency ratios, how would you rate Access Bank relative to other Tier 1 banks?
I think it's certainly there are 6 Tier 1 banks in the market, as you know, and I'll say Access Bank is really ranking number 2 or number 1, depending on the parameters you're looking at. In terms of efficiency, there's still work to do. But that comes from the sense of scale. In terms of assets, the bank will be number 2 now, only behind ETI. Yes. So if you take out ETI, they are number 1 amongst the traditional Nigerian banks. So you've seen that there is a massive operation. Obviously, having digested a big entity like Diamond Bank, you will still need time. Probably the period is usually about 12 to 18 months to really bring the cost containment back in alignment and begin to reap the full benefits of that merger. So efficiency ratios, there's still work to do there. I know, for instance, that non-performing loans went up from 2.5% as at the end of 2018. It went up to as high as 10% Q1 2019, but it's come down to 6.5% Q2 2019, half-year 2019. Now, the bank is guiding that they should be within the regulatory limits of 5% by the end of the year, which we think would be great.
Those are interesting results, no doubt. Now, Greg Jobome, do you think that Ike has given a fair assessment of your bank in terms of governance? And to what extent have these half-year results reflected the objective of the merger?
Well, overall, I think Ike's assessment is very fair. It's been an exciting period for the industry, for the bank, for our people. Obviously, it's the kind of challenge that many banks sort of back away from, because it's not something that you jump into so easily. We've had the experience, having done the same thing with Intercontinental Bank a few years back. So we're quite confident that, there is value to be, nurtured here if we get it right again. So all of that was at the foreground of, the board's decision-making, the due diligence that was done to ensure that this is going to be value accreting, for shareholders and for stakeholders. So all of the hard work that goes into the background, I don't need to bore you with, but at the end of the day, it generated the kind of numbers, that Chioke just mentioned and which we have published. Now, in terms of the overall governance direction and, how we see this panning out, it's very early days. We have quickly brought the machine together, i.e. the old Access Bank, the old Diamond Bank come together, is running, the work, together running from day one, which was April the 1st, started from obviously a few weeks back. Now that machine needs to work and grind out the revenue. So even what we're seeing now is just the beginning. So there is so much more synergy to be reaped from that journey. The people are gelling. Obviously, that you have to get the cultures, the work culture, everything gelling together, the systems optimized, people optimized, customer base optimized in terms of the channels of service, in terms of optimizing service to ensure that. So all of that is still to come. And if we're already showing this kind of numbers, I think there's so much more to come in terms of, the future and how that growth trajectory is going to go. In the short term, between now and the end of the year, and probably up to half of next year, we'll be doing all the cleaning up that we need to do. So Chioke mentioned about the inherited, loan book from Diamond Bank that took our NPA ratio from about 2.5 to 6.4%. That is, a massive improvement. If everyone knows where we're coming from, I mentioned Q1, we're already at 10%, from about 14, 15%, if you went back in time. So all of that means that work will still happen between now and over the next 6 months or so. A bit more cleaning up. If by the end of the year we can achieve 5% NPA ratio, that would be fantastic. But these are very difficult times, and that's a tall order, for you to set for us. And but we'll do our very best to try to achieve that. Access Bank has always had the lowest NPA ratio in the industry for as long as I can remember. So it is a place that we're heading back to. Now, how quickly? That's all it is. It's a matter of when. If not by the end of this year, then definitely at some point next year, it's a number that we're going to achieve. But in the meantime, it's the cleaning up, it's the recoveries. So the loans that went bad, Diamond Bank, all of that we're chasing to ensure that value, because that's part of the rationale for the whole merger. So it's the liability base, it's the customer base of Diamond Bank, which is still the big proposition in terms of value for this whole company. So the future is looking as solid as you can have it, and all the numbers from the results you would have seen all headed the right way. Not a single one is heading the wrong way. So all of that is should give even added confidence in terms of what the market should look forward to.
Sure. Well, I'm glad you mentioned the loan book. If we focus on that, how do you feel the bank has managed the loan book it inherited from Diamond Bank? And further, which risk management initiatives do you feel the bank has put in place to manage the burgeoning loan book?
Okay. Well, it's a bank, so a bank does loans, and some loans go bad. So that's the nature of the beast. So not surprisingly, we have we had a fair few of those with Diamond Bank. And we knew about them in the due diligence phase. So there is no surprise, there is no shock discovery after day one. So everything that we've seen is what we anticipated, is what we had reviewed, it's all the files we had seen, it's all some of the customers we actually met them even before day one. So we went in with our eyes very wide open. And in most cases, what we needed to do on a borrower-by-borrower basis, we also knew even before day one. What it meant was that we hit the ground running. Customer A, you had the 500 million that went bad. We've not paid it. What is happening? Let's reopen discussions. So those engagements they are in person, they're live. Where do you want to meet? You want to come to our office? We want to come to your office, wherever you want to meet. You can't ignore this problem, sir or ma. we have to resolve it. So it's at that level of discussion. Everyone in the bank is fired up to do that resolution. I don't want to bore you with details of nitty-gritty of banking activities, but what you tend to find is there are meetings called Criticized Assets Committee meetings, which is where bad loans are discussed in summary. Now, those discussions have been ramped up, the analysis ramped up. So the ones that are a bit shaky, we said, okay, this one is okay. The borrowers here are well-intentioned. They have a business model that is working. They have cash flows coming in. It's not dire straits yet. Let's restructure this one, and they'll be fine. Give them an extra 1 year, an extra 2 years to pay. And those ones, put them on a different track, and they're beginning to reap fruit. And when they do well, they meet a couple of payments, you are then able to upgrade them again. So by the end of the year, hopefully, you'll see a few more improvements coming from that. So that's restructuring. But you have those that are so far gone, there's not much you can do. So you take the provision, you write it off, and then you pursue them for straight recovery, which means that you are deploying all the apparatus of the law to go after them. And again, Access Bank has a reputation for doing that hard legwork. And we can travel anywhere to resolve a bad loan. And we'll go to any court, any jurisdiction, any channels of engagement. We try to avoid antagonizing our clients, but when the client is obviously a bit recalcitrant, we'll do that rough fight to get resolution. So the recoveries are also coming in. As you would have seen in our financials, there's about 14 billion recovery made, and that's straight to P&L in the course of this half year. And there is more of that coming in. So there are the restructurings, there are the write-offs. There are some loans that were in dollars, for example, and you're saying it makes no sense to keep them in dollars. They're prone to further devaluation. Let's convert them to Naira. So in some cases, they've been converted to Naira. Even a new lease of life, they have Naira collections, and they can keep servicing the obligation, and there's no problem. So plethora of different, measures taken for different types of, borrowers. Of course, there are the good ones. We inherited them. They were doing fine. Absolutely nothing wrong with some. So for those ones, we've kept them on a nice even keel, nice relationship management, enhanced service standards to ensure that they have no reason to be worried about the new, management of the bank. And in some cases, in fact, in most cases, we deferred to, so if you were a borrower in the old Diamond Bank and you are a borrower in Access Bank before the merger, you were borrowing at different interest rates. Mm-hmm. So we've decided that you're not going to borrow on the lower of the two interest rates to ensure that even our stakeholders, whether they are borrowers or other forms of customers that we have in the bank, they have the best of the two worlds. So again, it's helped to maintain that, stability in the customer base, whether it's on the borrowing side or on the current account, normal depositor side of things. So these measures have kept things, reasonably stable and on a path that's going to take us forward.
Yeah, interesting development, and it's heartwarming to know that you can actually embark on restructuring to go after loan defaulters, which is a lingering problem in the banking industry. Gentlemen, I'd like you to hold your thoughts on those issues. We'll be right back after this break to discuss more on the fortunes of Access Bank. You're still on to Global Business Report. We'll be right back. Stay with us. It's good to have you back on Global Business Report. We're still talking about the fortunes of Access Bank, and I've still got with me Ike Chioke and Greg Jobome, both of Afrinvest and Access Bank, respectively. Gentlemen, it's good to have you again.
Thank
you. Mike, from a market perspective, what would you say are the risks to Access Bank off the back of such strong half-year results?
Well, I think that the risk to Access Bank is a risk to any large corporate in Nigeria. I think that when you step back and look at the way the economy of Nigeria is doing, we can all agree that we're not growing as well as we should.
Indeed.
Q2 GDP numbers came out recently and was off from 2.1% growth we saw in Q1 to now just 1.94%.
All right.
Clearly, if you're a bank with the scale and size of Access, your growth is tied intrinsically to the growth of the economy. So when the economy isn't growing as well, then clearly certain projections you might have made for the scale of your business may be constrained. And I think that's the first endemic risk. On top of that, you then weigh in the direction of the economy overall. If we saw more reform, in the system, then certain sort of certain lagging sectors, you have power where there are a lot of risk assets have been created, And I don't see any hope in sight on how those borrowers are going to pay it unless you reform the power sector and the power industry. You have the perennial oil and gas sector, and I'm sure Access is exposed to that sector, without significant reform and sort of creativity in how the industry is run. Not much will change. It'll just be the same old thing, and you're trying to make the best of a bad situation. But at the same time, there are other areas of opportunity that the country has yet to unlock value, and those are begging. I mean, we are touching the edges on the agriculture space, but we have a lot to do in education, have a lot to do in healthcare, and these areas, while there's no growth in them, you then have the constraint of the weak human capital development index in Nigeria. And so when you're a bank with the size and scale of Access, and then you have a country that has very weak human capital development opportunities, then clearly that will always pull you down. So your human capital coming to the bank would have an impact. You have to spend more on training, spend more on security. We'll have issues of rampant kidnapping and all of that. So those are just risks within the context of Nigeria. And then outside of Nigeria, you're dealing with wider issues that have an impact on the Nigerian economy. You've got the US and China trade tensions. You've got the Brexit nightmare that doesn't seem to want to end. You've got security tensions in the Middle East, Israel, Iraq. You've got the Eurozone challenges. All of those things have an impact on currencies and then oil market. And then obviously, like you saw in the Access result, there were some derivative positions that went into a loss in this half year compared to a profit the year before. And that reduced non-interest fees and commission income, non-interest income. Those things have an impact to the extent that you see, for instance, maybe a decline in oil prices. Then obviously the Nigerian economy will suffer. Then Access Bank would obviously feel that brunt because some of its customers will be in difficulty. True. So you can look at risk from different perspectives, both from the very high level ones, but down to the micro ones that are, everyday issues for any particular branch. And I'll leave Greg to elucidate more on that. Yeah.
Mr. Jobome. Sorry.
All right, go ahead.
Very eager.
Okay.
We know that Access Bank's focus on its retail business has some sort of significant effect, or has it? Could you tell us more about how your focus on retail business has affected growth?
Okay. Well, retail has been the big deal in the bank for the past 3 to 4 years, easily, even prior to the merger with Diamond Bank. Of course, Diamond Bank was big on retail, both in terms of individuals as well as in terms of SMEs, et cetera, et cetera. So that was one of the value propositions in the whole merger discussions. Now, what we've done with that is to look at the entire Diamond Bank apparatus for driving retail. And actually, it is actually of a standard that is very high in terms of the systems, because to do retail, it's not a business for normal, a banker turns up and starts talking to you morning till night, on one small loan or the other. It works with digital, it works with technology, it works with minimum human interference in that workflow. Therefore, that apparatus was already set up in Diamond Bank. So what we've done is to take that and just, graft it onto what we had already set up in Access Bank. So right now, that is the place to be in terms of the future and driving that journey. Now, why this is critical, Ike just alluded to things around the oil sector. They need to diversify away from that. Nigeria is a very concentrated market, and at about 30% of Access Bank's loan book is in oil and gas. There are some banks with even higher than that. And over time, we've got to be able to say, let's move away from the oil dependence. Of course, it's not going to happen overnight because the entire structure of the market is tied to that, right from the earnings of the entire country. So those flows will take time, to be restructured. It's like turning an elephant around or a plane. It's that kind of move that needs to happen. But in the meantime, there are opportunities because Nigeria is a highly underbanked environment. So we said to ourselves, why is that structural realignment is happening? Let us be mopping up the financially excluded, segments of the market. So we've got millions of people today that are not even, they don't have a bank account, they don't have a card, they don't have regular banking service. And we said, these ones, we need to key into them. So how do we serve them? How do we get that first step into being enfranchised in the financial sense? So all of that is what we're working on now. We've set up what we call AFF, Africa FinTech Foundry, which is it's a research hub for the next level in terms of digital evolution. So that is keying into our lending programs. There's one that we call payday loans. Okay. Now, the way it works is if you have a salary that's domiciled with the bank, you are profiled for a loan. And within a minute or two, you can avail yourself of a loan. You don't have to go to any branch. You don't have to speak to anybody. It comes to you. That is the only way to do retail. And that's how we've done it over the past, like I said, 3-4 years. But it's ramped up over the past 1 year. And definitely since Diamond Bank came on board, that has moved to another gear. Now, in terms of the opportunities there, like I said, it's in driving that inclusiveness. Because the more we can mop all of those elements of our economy in, the more you enhance people's purchasing power in many different ways. So the small business that couldn't have access to a facility before, because he or she was quite content to play a small game with a little kiosk in one small town, suddenly they can have bigger capacity. They can produce more. They can sell more. Their spending power is enhanced. Their children can spend money. They can go to school. All of that spending power must be good for the economy. And the more a bank like Access Bank, being the biggest in the market, will have an example to show that actually we don't need to be so dependent, on the oil sector and the corporate lending to make money. Because you can make money even from the little bit you're, aggregating from all of these masses of people. A bank can survive on that. And definitely banks, in some developed markets, you see their loan books being 20% retail lending, 30% retail lending. And I'm talking of big global banks. In our own environment, these are much smaller figures right now. You're talking about 5%, 6%. So there is a big opportunity there to close that gap. And we are on that journey already. So there is more contribution to revenue, more contribution to PBT, more contribution to commissions and fees coming out of retail now than there was 2 years ago.
Let's switch gear for a second. We know that you have until the end of the month to meet up with the Central Bank of Nigeria's directive to raise its loan-to-deposit ratio to 60% by the end of this month.
Indeed.
Or risk sanctions. Are you on course to meet this target?
Yes. Yes, they are. Actually, yes. You already have met it.
Correct.
As at half year 2019, the mix went from 58.7% to 65.6%. So they're already within that range.
So that's an independent assessment, straight away. But definitely it's a threshold that, a bank like an Access Bank will not struggle to meet because we are active in the market. In terms of market share of industry lending, we are a significant player. So it's not a surprise that we are not going to struggle to meet that kind of metric. We are part of the engine, driving the economy right now with the kind of size and reach that we have, just less than 700 branches, 29 million customer base. There are many Nigerians now who are touched by Access Bank.
All right. Let's still on this issue, Mr. Chioke. Do you see most money deposit banks meeting the CBN deadline, and what impact will this have on their balance sheets and, of course, profitability?
Well, I think when we saw those numbers come from CBN, we reckoned that something like 600 billion to 1 trillion naira potential of creation of risk assets for the industry to meet it. Now, there are obviously some big banks that were on the weaker side, that's way below 60, and those ones who have the most to increase their loan book in order to meet that threshold. But if you didn't meet it, it just meant that CBN sort of, gave you some discount in terms of some of your ratios, how they looked at. But you have to work towards it. I think that overall, from talking to some of the senior bankers in the industry, they all felt it was a positive thing. It wasn't like CBN was saying you have to get to 80%, which is the upper threshold. But you've got to be no lower than 60. And most people are sort of on the sort of 50 average level, and moving it up to at least 60 or getting to 70 is helpful. So it's unleashed more creativity in the market. I mean, like you talked about, what Greg has talked about in terms of their retail lending. I've seen similar products coming out from other banks, both tier 1 or mid-tier banks, where you can now access facilities real-time online on your app or on their website. And so that's all very helpful. But you also see banks who are now taking whole industry sectors and understanding the entire value chain. So they're able to help customers, whether you're in the farm, for instance, in agriculture, whether you're in the processing business, or whether you're in the export of the finished goods. They actually understand the entire value chain. So that's what I felt that is very positive about it. And I don't see that that's going to be a huge problem. Obviously, for banks that have been more conservative on risk asset creation, they just have to build that capacity in-house. And they may make some mistakes and then record higher NPLs, and then by the next year or the year after that, they'll learn not to do that again.
Indeed, and on that note, Mr. Ike Chioke of Afrinvest.
Actually, I have one more question.
Okay, one more question. I'm sorry.
If you give me the
one
grace.
more question, please. All right.
If we head back to the merger,
Okay.
and we look at the current state of Access Bank, if we were to focus on human capital, can you share with us how the experience has been on the staff on the one hand, and on the other hand, how many, if any, of Diamondback staff did you let go?
Okay, it's one of those things that we value a lot. You need people to provide excellent service. Now, if your people are not up to speed, straight away you have a problem. It doesn't matter what you set at the governance level or at the very top as your goals. If you haven't got people to execute it, you have a big problem. So, as part of the merger discussions with Diamondback, we were very clear that we will need to retain every single person in Diamond. Why? You need someone to man the branches. We now have the biggest network of branches in the land. Now, that big network needs people that have institutional memories of those customers in those locations. So just asking 100 people to go from a branch or 20 people to go from a branch, the customer turns up the next day and John is not there, Mary is not there. You've introduced to John Bull, who is struggling to understand what this person is talking about. Yeah. So we said, we're going to be extremely careful. Now, the former Diamond Bank, they had a strong brand for retail, and we're very keen to retain that as much as possible. So the strategy was, we are not going to let anyone go willy-nilly. Not different from any organic, when people don't perform up to a certain standard set by an institution, there's what's called a natural attrition rate in every bank, in every corporate for that matter. You set KPIs, key performance indicators. This year we need you to achieve X%. What did you achieve? You achieved your X%, excellent, carry on. Or, we failed, okay, we'll give you a chance to redress and improve. So that has always been the model in Access Bank. And it hasn't changed one bit, even with the combination with Diamond Bank. So the point was, there have been some departures from Access Bank, from people who have come from Diamond, but also some departures from people who were in Access Bank before the merger. And for various reasons, people will survey the market. They might see an opportunity to do something different. Those are the cases that you've seen. So no one has been asked to go because there was a combination with Diamond Bank. And that was a deliberate strategy to ensure that we keep the fabric of that customer base, otherwise we'll lose the whole essence of the merger. So I hope that addresses your concern there. Yeah?
Yeah, to a large extent. So what are the biggest drivers of this growth, you think? Just before we...
Okay.
Yeah.
There's growth in the market?
Yes,
or in Access Bank?
In Access Bank.
Well, you will see that it's a bank that has been on a trajectory from, let's say, 2002. From that period on, we've always set goals that are what you might call a high-performing institution should be able to set and achieve. It just requires that mindset that says, we're not here to just mark register, as we say. We're here because we want to deliver excellent service. We want to be the best bank in the market. We want to have the best people working in the industry. We want to be, the number one bank when you talk about banking in Africa. We talk about And why Africa? Why not the world? You know, I mean, the HSBCs, the Barclays, you know, sorry to mention a few brands, they started from somewhere, and today they are on everyone's, you know, lips. You know, these are, you know, big global banks to work with. Nothing says that an access bank cannot be that. All it takes is having the focus and the policies and the people to drive it. Once that hunger is there, the high performance ethos is ingrained, just be watching. You know, it's the kind of thing that it must come out of Africa at some stage. You know, so why not this bank? The ingredients are there, the foundation is there, the hunger is there, the willingness is there. We just need more converts, more people to make that happen consistently over time. And before you know it, it's 50 years, and then it's 100 years, and then it's 200 years. And it's shown that we'll outlive everyone within the bank today. That is the goal. And so why that aspiration? What we should be asking is, why not that aspiration?
Really?
Indeed.
Every corporate should have that aspiration. That's how the big players are made globally.
If I may add a few words to that, I think Access has made an outstanding performance in terms of the track record.
Okay.
If you recall from inception, you know, when it started as a very small bank, and then it was then hit by the Soludo banking consolidation wave, and they quickly scaled up to raise the minimum capital of 25 billion. And the opportunity of Intercontinental presented itself. We thought at the time, my goodness, that's something like a tilapia swallowing a shark, you know. But they managed to achieve that merger and combine it, you know, quickly. And then that experience has probably been what has helped them do the Diamond merger very quickly. I don't see any other organization in the banking industry that has been able to, you know, complete their mergers so much as efficiently as Access has done. You know, we were advisors to many banks during the banking consolidation. You know, various banks that came together, maybe 4 or 5 banks, to form a new bank. At least there are 3 or 4, I won't name names. They remain more like a mosaic, you know, that fixed colors in one position. They didn't really merge internally, although they were answering one legal name. And that created problems that lingered on for almost a decade before they began to unravel. But in the case of Access, we saw very quick, you know, transition to new management, new vision, and continuous growth momentum. And that has then pushed the organization. I remember when Iboje was running it, he was telling me, I'd want to be within the top 5 banks in Nigeria within the next 5 years. And I thought, you know, you're barely at the bottom of the top 10, you know, you're scratching, how are you going to jump past all those people? And look, today, there are 1 or 2, depending on which metrics you're looking at. So
indeed, it's good to raise the bar and stick to it, as it were.
Absolutely.
That's the moral of the lesson.
Yeah.
And it's good to see Access Bank doing that. It's good to have you with us, gentlemen.
Thank you.
Femi, you're good?
I'm good.
All right. All right, Mr. Ike Chioke of Afrinvest, and of course, Dr. Greg Jobome of Access Bank. Many thanks for your thoughts on those issues, and we wish you many more success stories.
Thank you.
Thank you very much.